All right, if you bought the dip yesterday, today could hurt. 30 minutes until the start of the cash trade. I'm Matt Miller. Dani Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, China raises the stakes in its trade fight with the U.S., this time targeting American shipping. Wall Street absolutely crushes estimates. A resurgence in deal-making, boosting revenue at JPMorgan and Goldman Sachs, but that was expected. And a rough ride for General Motors. The automaker takes a $1.6 billion hit after rolling back its EV production plans. Let's take a look at the banks, though, as they are kind of kicking off earnings season today. We did expect, and I don't know how this is possible, we did expect the banks to beat estimates. You'd think analysts would just raise their estimates, right? JPMorgan Chase down right now more than 1% in the pre-market, and Goldman Sachs off 2.5%. So even with, knocking the cover off the colloquial ball, the shares are still trading off. Citigroup right now is up. In terms of what we're watching today, Bloomberg Chief Wall Street Correspondent Sri Natarajan joins us here at the desk, and he's got the latest on the bank. So Sri, I saw a story this morning on the Bloomberg saying which banks were expected to beat estimates, which to me, that doesn't make any sense. Why don't analysts then raise estimates?
Well, they can only go about how the management is guiding them, and management's always smart to guide them to a place where they are sure when they report the numbers that they can try and beat those estimates. And that's what they've done this quarter. If you look at all the big numbers, especially in capital markets, especially in the investment bank side, when you look at trading and the deal-making side of things, all the banks have done really well. And that was kind of expected.
We knew that.
As the year has progressed, you've seen a big tick up in deal announcements. That is now starting to flow through into fees. There has been heightened trading activities, and along with the financing side of that business in the markets unit for a lot of these banks, that has meant that the numbers have come in pretty good. So the next question is, if that's the case, why is JP Morgan trading down? Why is Goldman Sachs trading down? And the answer to that lies in the fact that when you're up 35% for the year, the market was already expecting you to perform well and even outperform. But in the last few days, especially with all the overnight news out of China, if there is any real risk that this spat grows into something worse than a spat, that could put a chill in markets again. That could make the big corporate clients uncertain again. And that would mean that all these businesses that have been firing on all cylinders for JP Morgan, for Goldman Sachs, for Morgan Stanley, everyone else, that could slow down, and that could bring down their numbers and therefore impact their stock again.
Right, so the big macro news affects them as well, obviously. And, whether or not they beat estimates, that's kind of a numbers game. It's kind of a parlor trick that we play every quarter. It doesn't matter, I guess, to serious investors. But there is the color you get, specifically from Jamie Dimon every quarter that we wait for on the economy, and the involvement or the exposure that they have to these big bankruptcies that we've been hearing about. Tricolor, First Brands. What do we know?
So let's hit off with the macro factors first, because when you look at the earnings results and try and read the tea leaves, what is it telling us about the broader consumer economy, about the broader economy in general? Well, to be frank, not a whole lot other than the fact that the U.S. economy is still very resilient. But Dimon, in his prepared remarks, in his statement, was very clear to point out that there are a lot of macroeconomic concerns brewing that could have a big impact on 2026. He's talking about the weakening labor market and his fear that there could be sticky inflation. That's really not good. And then you look at some of these idiosyncratic issues, if you want, with Tricolor, with First Brands, and how it has affected banks. JP Morgan was not exposed to First Brands, but in the case of Tricolor, it had a $170 million charge-off. That's the new news we got from JP Morgan today, that their hit from the Tricolor fiasco was about $170 million. That contributed to a roughly $800 million credit cost. They said there's another one-off situation where they've been impacted a little bit. Again, nothing systemic that we could point to. Dimon did say Tricolor was not our finest moment, and when something like this happens, you can be sure that we are reviewing all our checks and controls, and sometimes you just can't avoid these situations, but we're going to do everything possible to make sure it doesn't happen again.
What do we know about profitability for these banks looking forward. I heard Allison Williams from Bloomberg Intelligence say that, especially for Wells Fargo, they've raised their return on tangible equity target.
Well, Wells Fargo is actually the most interesting news item today, and that's why the stock in the pre-market at least is up more than 3%, because remember back in June that punitive action from the Federal Reserve, from their chief regulator that had placed an asset cap on Wells Fargo for so many years, that had been lifted. So that immediately led to questions about what would this mean for Wells Fargo? Can it finally narrow the gap with its bigger rivals like Bank of America and JP Morgan? Back in June, back in July, you didn't get that level of clarity from Wells Fargo, and that's why maybe the stock momentum also peeled off a little bit. But today they said they are lifting their medium-term targets for ROTCE, for their return on tangible common equity, to about 17 to 18%. That means the market can be certain that as their balance sheet grows, they will invest in activities that will surely drive up their profitability. And they're keen on sort of trying to make a play even in the investment bank segment. And you've seen their fees grow there. They're still a minnow compared to the big players, but that means there's room to grow.
All right, very good wrap. It was as good as I expected. You meet estimates. Sri, thank you very much, Sri Natarajan, because I knew it was going to be good from him. Let's turn to the auto story now. General Motors reporting a $1.6 billion charge related to scaling back its EV plans. The company says in a regulatory filing, quote, following recent U.S. government policy changes, including the termination of certain consumer tax incentives for EV purchases and the reduction in the stringency of emissions regulations, we expect the adoption rate of EVs to slow. Joining us with more is Bloomberg Intelligence Global Autos and Industrials Research Analyst Steve Mann. And Steve, this is especially interesting because I thought General Motors had come up with this strategy where it was going to be able to sell a lot of pre-October inventory to its dealers, take that EV credit, and continue to pass it along to customers for the months to come. But I guess it's decided not to try that.
No, they decided not to do that, and that 1.6 billion write-down is huge. I mean, GM was probably the most aggressive, if not global, among the big three, Detroit big three, in moving into EVs. They have a very complete, full EV portfolio that they need to really rethink what they're going to do with it.
So how is GM positioned in EVs now? I know it's a story of slowing growth really for everybody, but they have such a huge product offering, right? Everything from the $28,000 Bolt to the $160,000 Cadillac IQ, and in between. Are they outperforming the rest of the industry?
Certain models they are outperforming, but I really think that they do need to rationalize that portfolio. They'll continue to launch the Bolt. You've seen it in the media. It's priced under $30,000. Addresses one of the issues that consumers have with pricing of EVs. But anything in between, right? Like the Blazer. Like some of the pickup trucks, those are less popular with consumers. And I wouldn't be surprised, looking at sales in the next couple of quarters, if those models go away.
All right, interesting stuff, because such a big offering, right? Blazer, Equinox, Sierra, Silverado, Hummer. It's just a huge gamut for EVs from a mainstream, from an incumbent car maker. Steve Mann of Bloomberg Intelligence, really appreciate your time. We want to get to the big China story, though, because that country is hitting back at the U.S. Rising trade tensions are raising them, I should say, between the two countries. China sanctioned American entities of the South Korean shipping giant Hanwha. This coming as President Trump's tariffs on furniture and lumber take effect today. Bloomberg Washington correspondent Tyler Kendall has the latest from outside the White House. So is it going to be fine?
Well, that's the big question, Matt. Of course, this move when it comes to the sanctions is escalating a long-standing dispute between the U.S. and China when it comes to the maritime sector, really considered to be the latest point of leverage amid these tensions. As you mentioned, China moving to sanction and target 5 U.S. entities of this South Korean shipbuilding giant, as really this White House has looked to shore up ties with allies in Asia to help bolster its own position within the sector. You'll recall even South Korea had committed $150 billion in planned U.S. investment earlier this year when it comes to shipbuilding in order to clinch that trade deal with this White House, because the backdrop here is much like critical minerals. China really does have this grip when it comes to the shipbuilding sector. It accounted for more than a third of the global fleets last year alone. Now, the U.S. itself, worth mentioning, did take its own action this morning, starting to impose fees on Chinese ships that are docked at American ports. That's the big question, though, what you asked, because in the backdrop here, we are just leading up to this potential meeting between President Trump and Chinese President Xi Jinping at the end of the month, as the White House maintains that threat of an additional 100% tariff still remains on the table. We did hear from the Treasury Secretary Scott Bessent in an interview yesterday saying that he expects that meeting to still take place. He called China's new unveiling of its export curbs on critical and rare earth minerals last week to be a miscalculation. In his words, Matt, we might get some developments later this week. It is worth mentioning that China's vice finance minister is here in Washington for meetings, and a person familiar does confirm to us that he's already been in touch with Scott Bessent's team.
Hey, I want to ask about the shutdown. What is it, day 14 right now? Tomorrow, the military apparently is going to get paid, and that could just allow this shutdown to go on even longer, right? Because it doesn't force the Democrats to come to the table.
Right, exactly. So we have seen some of the pressure points been eased, including military is going to get paid. Our understanding is this is going to come from $8 billion in unallocated research funding from the Pentagon. Coast Guard also is going to get paid. That's going to come from diverted funds from the Department of Homeland Security. And then another third pressure point I'll put on your radar that appears to be eased is that the White House confirms it's going to use tariff revenue to fund one of the supplemental nutrition programs for women and children. But all of these things, of course, are facing legal scrutiny, while both sides of the aisle are happy that the administration found solutions. But there are some areas that don't have as easy of solutions, such as small businesses being able to get loans, as well as these disruptions we're seeing across the country in airports. So, Matt, we're going to have to see if this keeps ramping up the pressure.
All right, Tyler, thanks very much. Bloomberg's Washington correspondent Tyler Kendall there at the White House. Some breaking data from the International Monetary Fund, the IMF, warning that the global economy is showing signs of strain from sweeping U.S. tariffs and protectionism. The global economy expected to grow by 3.2% this year, up from 3% predicted in July. So that's a gain. In 2026, growth is seen, though, edging down, still to more than 3 at 3.1%. In terms of futures this morning, we see them down across the board. S&P futures, after we had a gain in the cash trade yesterday of 1.5%, now down 0.9% as the China concern is raised again. Let's get a look at some of the other movers on our radar today. Moody's downgraded its outlook for Stellantis from negative to stable, to negative, I should say, from stable. That's a downgrade, citing weak operating performance and uncertain profitability. Oracle plans to use 50,000 AMD chips next year for its data center build-outs. That's good news for the chip maker. And Johnson & Johnson raised revenue guidance for the full year after earnings topped estimates. It also plans to separate its orthopedics business from the rest of the company within the next year and a half or 2 years. Next hour, we're going to speak with Johnson & Johnson CFO Joe Wolk right here on Open Interest. So stick with us for that story. And coming up, we're going to get the analyst's view of bank earnings with Baird's David George. This is Open Interest. Let's get now to high interest to look at what's making headlines around the world. In a bid to make the European Union more competitive, the bloc is drafting rules that could require Chinese companies to share technology and build more of their products in Europe in order to gain access to key markets like cars and batteries. That's what the Chinese have always done to their competitors coming in. The plan would also push firms to use EU-made materials, hire local workers, and possibly form joint ventures with European partners. Now, sentiment among small business slipped last month to a 3-month low as owners grew less optimistic about the economy and more uneasy about rising costs. The NFIB's optimism index dropped 2 points to 98.8, with more owners expecting weaker sales. Small business owners are planning price hikes to offset inflation. The group's uncertainty gauge also jumped to the highest since February. And the protein boom is hitting the breakfast aisle. Pop-Tart maker Galinov is rolling out Pop-Tarts Protein. next month. It has the same frosting and sprinkles, but with 10 grams of protein per serving. It's part of a food industry rush to add protein to everything from Doritos to ice cream as shoppers and GLP-1 users chase higher protein diets. Let's get back to bank earnings now. JPMorgan soared past estimates for trading and investment banking fees thanks to a resurgence in deal making that we saw coming from a mile away. The surprise, though, Wells Fargo raised a key profitability metric, its first major growth target upgrade following the removal of regulatory restraints. Joining me now is Baird senior research analyst David George. He has a sell rating on JPMorgan and a neutral on Wells Fargo. And David, I guess, the first question has to be, will you change that rating on WFC? Because it's going to do better, it looks like, than the market had anticipated.
Hey, Matt, good morning. With respect to our ratings, we're always obviously evaluating those, and we'll publish our thoughts sometime later today after the conference call and kind of having the opportunity to analyze the numbers. But as it stands now, we're staying neutral on Wells Fargo and underperform or sell on JPMorgan shares.
All right, so JPMorgan, everyone's talking about how great it did compared to expectations. How do you look at these banks, David, before they come out? Since we knew deal making was fantastic, we saw IPOs coming back. We heard from Jefferies that trading was going to be good. So how do you get into these, and what's your reaction to the earnings at JPMorgan?
Well, the earnings for both JPMorgan and Wells Fargo, Matt, were both very good, and I would characterize them as excellent, really. I think it's important to note that, particularly for JPMorgan and the other investment banks, this was probably the highest bar that we can think of in many, many years with respect to just the expectations going into these numbers. And it is no secret that deal activity is very high, and there's been a lot of optimism around IPO, secondary activity, as well as M&A. Trading has been very good, but it's really a function, we think, of just very high expectations. And to give you some context, JPMorgan trades at over 3 times tangible book value. That's the highest valuation of its existence. We've covered the stock for 25 years. It's never been more expensive. So I think it's important to differentiate the company, which is outstanding, and the stock, which is not particularly interesting to us here at 3:05 this morning.
What's your take on the consumer here? It looks like the macro picture has also a lot to do with movement in shares today, certainly for JPM and Chase. And I know you cover also other consumer stocks, for example, American Express.
Yeah, so far it continues to show what many call this K-shaped economy, where the high end is doing exceptionally well and the lower end is having some challenges. JPMorgan's credit card delinquencies were actually down quarter over quarter, which was encouraging, and we think that bodes well from the likes of American Express. It kind of remains to be seen on Capital One, which is a stock we like a lot. But consumer today is in relatively good shape. We're obviously keeping an eye on things like retail sales. Unemployment is something obviously that's going to get a lot of attention in the months to come as we get this return to office mandate across corporate America, along with the impact of AI. So, but credit quality broadly, other than some of the well-telegraphed corporate one-offs like Tricolor, credit quality looks actually very good. And I think this portends well for what we'll see from the regional banks the balance of this week.
The regional banks, I guess you like those stocks at least a lot better, David. I look down the list at, Huntington Bank shares, M&T, Fifth Third, PNC. You've got outperforms on all of those. Why do you like them better than the big money center banks?
Yeah, I think it's a function, Matt, of just the risk reward of those stocks and expectations around those stocks is materially different than the mega cap stocks. This is really the widest differential that we've seen in the last 25 years between the valuations of mega cap stocks versus mid cap stocks or slightly smaller stocks than the mega caps. And you can buy a stock like PNC, Fifth Third, Huntington, as you said, for 9-10 times earnings, and JPMorgan trades at 10 times pre-provision earnings or 15 times forward earnings. So it is not a reflection of the company. It's just we cover stocks and are trying to help our clients make money. And we think that there's a good opportunity on a relative basis in a lot of these regional bank stocks. And we're starting to see, Matt, an improving yield curve, and loan growth has showed some signs of life as well. So if the Fed is on a cutting campaign, which we think they are, regionals are going to be in a position to be able to make money on both the asset side of the balance sheet as well as the liability side of the balance sheet. And we think that portends well for pre-provision earnings growth at a lot of these regionals over the next several quarters.
David, great to get some time with you. Really appreciate it. Baird Senior Research Analyst David George. Coming up, we begin the trading day with JoAnne Feeney as trade tensions send markets down with earnings season kicking off. This is Bloomberg Open Interest. Quick look at futures ahead of the opening bell. We're down across the board. We had a good day yesterday after a very bad day on Friday. We were down 182 on Friday, up about 102 yesterday, and now it looks like we're going to lose more ground when the cash trade opens. A look at Walmart pre-market as the company says it's partnering with OpenAI to create shopping experiences on ChatGPT. Users will be able to shop Walmart directly on the app by clicking a buy button later this fall, and as a result, the big box store up 1.7%. We are looking forward to the stock market open. We're going to be joined by JoAnne Feeney, and then later in the program, legendary trader Paul Tudor Jones. This is Bloomberg. We are moments away from the start of the cash trade today. This is Bloomberg Open Interest. I'm Matt Miller. Looking at futures, down again. They were up yesterday. They were down Friday. They're gyrating is the word Will Shaker has written in for me. Here, S&P futures down 0.9% after a 1.5% gain yesterday, a 2.7% drop on Friday. NASDAQ doing a little bit better, 1.1%. The small caps even better, 1 1/3. You have the opening bell on the New York Stock Exchange. Etsy ringing the opening bell. They've had a banner year. Year to date, those shares are up 33%. Although, if you're a longer-term investor, they're down about by half over the last 5 years. This company, Collegium, is up by half over the last 5 years, up 50%. They're up 12% year to date. It's a pharmaceutical company, and they seem to be doing something right, or at least we need their product, so we have to pay for it. In terms of stocks to watch, we've got the banks here. Is this pre-market? We should see the live trade. Pre-market, we were down across the board, and the cash trade is going to be likely similar. Even though JP Morgan earnings soared past estimates for trading and investment banking fees driven by market volatility and a pickup in deal making. Goldman Sachs deal values topped $1 trillion in the third quarter, lifting revenue to a record. And Citi beat estimates across all 5 of its major business divisions. Now we're looking at the cash trade here, and there's still red arrows across the board because investors expected this. Market volatility is accelerating as China and the U.S., this is another reason, China and the U.S. up the ante on trade tensions. We've seen sizable moves in major indexes since President Trump on Friday threatened 100% tariffs on Chinese goods. Then on Sunday, he said everything's going to be fine, so investors bought the dip. And now China said, hold on a second, we have to deal with your shipping. So we're down again. The VIX climbing to levels that have not been seen since June, right now at 21 and 2/3, but nowhere near the 50 handle in April. So we're at least far away from Liberation Day. This sets up traders for a volatile earnings season. Let's bring in Advisors Capital portfolio manager and partner JoAnne Feeney. And JoAnne, what can we expect? How do you deal, first of all, with this trade tensions piece?
Well, good morning, Matt. It's certainly never a dull moment here. You know, the trade tensions obviously flaring up, and investors really need to try to keep some long-term perspective in this situation. Now, we know that trade barriers of 130% tariffs on Chinese imports would be very problematic, particularly for a lot of small businesses and households, but also for large businesses that derive a lot of their inputs from abroad. So it's a significant threat. It's most likely a negotiating tactic, although China increasing the rhetoric overnight doesn't help things. So a long-term perspective is helpful. Keep in mind that there are lots of different areas of the market in which to invest, some more resilient than others to this kind of a tariff threat.
So which are they? I mean, what do you want outside of AI? And we'll put that aside for a moment and talk about it.
Yeah.
I promise we'll get to AI. Is it a bubble or not? But in terms of safety, in terms of a harbor, where do you go?
Right. So, we have different strategies here. One of the ones I manage is our core balance strategy. And in that strategy, what we like to do is generate a bit of a higher dividend yield than is typical for the S&P 500, about double. We're trying to get about double the yield. And that does create an opportunity for investors to ride out some of the stock price volatility because they're going to be getting those cash dividends, every quarter, every 6 months or so. And you can find companies there that are more stable to these kinds of shocks to the economy, whether it's in consumer staples or in energy, in particular in the pipeline companies, which don't tend to trade closely to the price of oil, for example. You can also find some stability in some REITs and in some of the financial stocks. So looking for higher income is one way to find sort of high quality companies that generate that yield that helps investors ride out these stock price volatilities.
You like Walmart, TJ Maxx, they're in your resilience bucket. What do you think about the announcement? Actually just crossed, so I'm not sure if you even had time to see it, but I do note you have a Bloomberg terminal next to you, so I'm guessing you're caught up. Walmart is going to work with OpenAI to put a buy button on ChatGPT.
Yeah, and that's a great thing for investors to see. More and more applications of AI are appearing, whether it's in consumer retail like this, whether it's in industrial companies helping farmers, whether it's in IT services. So to see this kind of an announcement is, I think, very helpful for folks to recognize that real applications, profitable applications are emerging. I know it's been hard to see much into the future for how valuable AI could become, and we don't know, right, how valuable it will be. But this kind of an example helps investors see that. And obviously, Walmart, you're right, is one of those, stable, relatively high yield, resilient companies, along with TJ Maxx and some of the others in the staples group that can help investors ride out this kind of volatility.
Are you worried about an AI bubble? We had a survey that showed more than half of investors think that we're in one right now. That doesn't mean, obviously, the gains can't keep going. That doesn't mean we're about to see it pop, but are we in a bubble?
We don't believe this is a bubble, and here's why. For the comparisons that some folks are making to the dot-com crash, we have a very different set of companies involved that have much stronger balance sheets that are generating significant cash flow. Now, I'm not talking about all of the players, like obviously OpenAI is not one of those, but the Microsofts, Googles, Amazons, and their suppliers like Broadcom, NVIDIA, AMD. These are all companies that are making real profits. And we are, again, starting to see more and more applications. One way I would like folks to start to think about this, the deals that are being made between NVIDIA, OpenAI, AMD, Broadcom, OpenAI, and a bunch of private companies have been referred to as circular deals. And boy, this is a concern. We have sellers of chips providing the money to their customers to buy those chips. And isn't this a terrible thing? Think about it this way. If this is a way for these companies to become vertically integrated in some sense. If we had a single company providing the AI services and building its own capability to do so, including making its own chips, that would be a vertically integrated firm, top to bottom, all providing AI services, and building and investing in that capacity would be a perfectly sensible thing to do, and no investor would bat an eyelash at it, provided the firms had plenty of cash flow to pay for it. So think about it as sort of a different way to get to a vertically integrated firm, but a better way for investors, because investors can then pick where do they want to invest in this AI architecture. Do they want to own the chip companies, the service providers, the network suppliers? Instead of having it all in one firm, like a vertically integrated firm would do, you have separation of firms, which gives investors more control over the risks they want to take. So in some sense, it's a more efficient way to have essentially a vertically integrated firm. And again, nobody would be worried about one big company making investments in their future product lines and services like we're seeing in these so-called circular deals.
All right, JoAnne, that's a great way. That's a great place to leave it. Very interesting take on it. Advisors Capital Portfolio Manager and Partner JoAnne Feeney talking to us about this market, where to find some safe haven and the potential of an AI bubble. She says it's not. Let's get a quick check on what's going on in the stock market right now after a little gyration from Friday down to yesterday up to back down again today. This is the move screen, a great place to get all the information. You have 148 gainers right here with 350 down. So it makes sense that we're off right now 1.3% or 88 points. On the plus side of the ledger, Wells Fargo really is the bank that's come out with the news today as it raises its return on tangible equity estimate for 2026 to 18%, 17 to 18%. That is a positive surprise for investors. And Walmart making a deal with OpenAI doesn't hurt, a gain of 1.5%. On the downside, you've got all of those companies that, it was a Bank America survey, actually. Bank America surveyed global portfolio managers, and 54% said we're in an AI bubble. NVIDIA down 4%. Broadcom down 3.8%. Amazon down 2.7%. Later on in the program, I am going to ask Paul Tudor Jones this very same question. Is this a bubble? And if so, how far along are we? He's going to join us at 10 o'clock. Coming up next, banks continue to beat earnings as asset valuations balloon, but traders are not buying. They're getting sold off today. More on that financial outlook next. This is Bloomberg Open Interest. Time now for our top calls. Some of the analyst action and focus this morning. First up is T-Mobile getting an upgrade to a buy at RBC. The firm expects the telecom operator to see stronger subscriber growth versus its peers. The company reports earnings next Thursday. Warner Music is getting a bullish upgrade from Wells Fargo thanks to a successful turnaround at Atlantic Records. The analyst says the label hit its highest market share in 3 years under its new CEO, and he believes Warner's growth is set to re-accelerate. And finally, Salesforce is getting a downgrade at Northland Securities. The downgrade comes amid a lack of acceleration from the company's AI offering. The downgrade comes ahead of the company's closely watched Dreamforce event that kicks off this week. But let's get back to the bank earnings. JPMorgan soared past estimates for trading and investment banking fees. Wells Fargo raised a key profitability metric, and Citi beat estimates across all 5 of its business divisions. Bloomberg's Catherine Doherty covers the sector for us here at Bloomberg and joins me now. Why do we even bother talking about estimates? Honestly, what is the point of talking about these analyst estimates that we know are based on the company sandbagging?
I would not say that is a guarantee every quarter. The companies are obviously trying to outperform and prove to the market that they have more, not just in their performance for the third quarter, but looking ahead. So they don't want to signal that this is the end. I think that you're also hearing some very interesting commentary from the executives this morning. We've kicked off the calls with both the media and with analysts. Today, we had Citigroup's executives talking about the U.S. consumer. They're talking about a tale of two cities. They're saying that at the high end, those with much money in their accounts, they're spending at higher rates than the lower end, so they're calling out that differentiation there. JP Morgan is talking about the various risks or exposures to non-bank financial institutions. They're saying that that exposure is manageable right now. They feel comfortable with it, but Diamond is also saying that this could get worse in a downturn. And he says, quote, "I suspect in a downturn we'll see higher than normal credit losses in certain categories." So it's really not just the results and the various beat or misses in the estimates. It's what is ahead and what the executives are saying as it relates to the economy and the outlook moving forward.
And their exposure to high-profile bankruptcies, First Brands, Tricolor. We learn a little bit more about who has it and who doesn't, right?
That's right. So today, JP Morgan did reference that they have some exposure, very minimal, 170 million, to Tricolor. They said they do not have exposure to First Brands. Citigroup asked the same question. I think this is going to be a trend for all the banks in today and tomorrow. And Citigroup had said that they have no exposure to either company. So I think that this is a good opportunity, if banks haven't come forward yet to talk about their potential exposure, to do so now and to give some clarity to the market.
In terms of Wells Fargo, Allison Williams was on Bloomberg Radio this morning, she of Bloomberg Intelligence, and she said this is really the story of today's earnings because they raised their return on tangible equity target for 2026. And this is a standout where we actually learned something new about, the outlook from a bank.
It's a new era for Wells Fargo, specifically because their asset cap has been lifted. So that means that they can basically take more risk than they had been previously. They were constrained. So investment banking was actually a standout for them, even though they are quite small compared to the likes of JPMorgan and Goldman Sachs. If you think about the future for Wells Fargo, that is what Allison is referring to in terms of the metrics to keep looking for. We haven't had a lot of quarters yet where we've seen the bank be able to perform without this asset cap. So now we're getting a little flavor of what's ahead, and that could be a big upside for them. That's expected, given that they did have those constraints that they were operating under previously.
We've seen some incredible gains. I mean, not just for Wells Fargo, right? If you look at JP Morgan and Goldman Sachs and Morgan Stanley. One of the things David George from Baird told us earlier was, for example, a drop of 3.5% at JP Morgan today. That's not because it's a bad company. That's because the stock has done so well. You see here it's tripled over in the last 5 years. So these stocks have really outperformed.
The financial sector has done quite well. That is not across the board. Some laggards are not. There's been gains, but it's really then the question of who is gaining faster or more than their peers. And you've seen some fall-offs just in recent days. Friday was a really bad day across the board. It wasn't just due to financials or within that financial sector. Today, I think that because a lot of the estimates were baked in and there was an expectation that deal making was going to be coming back and that trading was also going to be quite strong, I think that's the reason you're not seeing the shares react in such a positive way, because these are good results overall.
They're not immune to the macro issues. Jamie Dimon saying, this is a quote, "There continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation."
That's right. Yep. And we're going to look out for more commentary. Citi's going to have its call a little later at 11 o'clock. And every time these executives are able to give their sense, especially because we've had a delay in job reports and some of the other consumer data points that economists and the rest of Wall Street really look to in order to gauge where we're going in the future. So now it's up to the banks to give what they see just based on their own performance and their own data and spending.
All right, Cato, great wrap up. Thanks so much for joining us. Catherine Doherty there covers banks for us on the other side of the building. You can follow our coverage of bank earnings from Catherine and her colleagues on the T-Live blog. If you have a Bloomberg terminal sitting in front of you, type TLIV go for that. A check on what's going on with stocks right now. We're down 1.25% on the S&P, a loss of 83 points. So we're still far below where we opened on Friday morning. The Nasdaq down 1 2/3% right now, 24,340. Coming up, Johnson & Johnson raises its full-year forecast while announcing it will separate a unit of its business, the orthopedics unit, I believe. We'll bring you the details with the CFO. He joins us on Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what stocks are doing right now, about 20 minutes into the session. S&P 500 down 1 1/3% after gains yesterday and a big drop on Friday. We continue to gyrate on trade tensions. Nasdaq down more, getting closer to 2%. That drop, and the small caps holding at a 1% loss. Take a look at what's going on with NVIDIA right now, down 4.1%, and that is a huge weight on any index on which it's listed, definitely on the S&P and the Nasdaq. Intel down 6.5%. Tesla off 3.6%. There was a Bank America survey out in which 54% of the respondents said we are in an AI bubble. GM right now, what is going on? General Motors is up 0.1%, even after saying a reorg of its EV business is going to cost $1.6 billion, which is a lot of money. Eli Lilly and Johnson & Johnson are both down right now, and we're going to talk a little bit about pharma because Johnson & Johnson is boosting its sales forecast for the full year. It also is announcing that it will split off the company's orthopedics unit. Cynthia Coons, who leads our healthcare team, joins us now with the latest. So a couple of different big pieces of news for J&J. Cynthia, where do you want to start? What do you think is more important to the investor?
I think the orthopedics split is a pretty big move for a company that there have been a lot of questions about whether or not or why they're keeping the medical device business along with pharmaceuticals. So taking out this piece of it sort of answers maybe some of the questions of what they strategically see fitting with their company, but also just sort of, I think, continues to raise questions about devices sitting alongside pharmaceuticals in a big company like J&J.
And they continue to, divide off, as a lot of companies, conglomerates have been doing recently. We're in a cycle where they're spinning off the units. I've been through cycles where they build them up as well. What do you think Joe Wolk is going to say about this? We're going to talk to the CFO in the next hour. Is this part of his strategy to really get laser focused on, one business?
Well, I think they want to continue to tell the story about the medical devices belonging with pharmaceuticals, but specifically they want to look at medical devices from a big innovation point of view. And so the story I think they want to tell at this point is that they can use a medical device business to innovate in surgery, or they've been trying to work out drug device combos and things that are just on the more cutting edge side of orthopedics than, say, continuing to make hips and knees and things that maybe don't see the bigger step change in innovation. So I think that's the story they're telling. It's to improve margins, basically. They're trying to get rid of the lower margin part of the overall med tech business. But interestingly, in all of this thinking, they've decided to still keep med tech with pharma. So they'll continue to have to sell that story to investors.
I hope they make an elbow. I need an elbow. You can get a good knee, you can get a good hip. Yeah. Elbows are still a problem. Let's talk about the drug prices because we've seen deals from Pfizer and AstraZeneca with the Trump administration on pricing. What are we going to hear from J&J on that front?
So they've said the dialogue is constructive. We're not sure exactly where they're at in this conversation, but from what we've seen so far and the sort of pattern that appears to be emerging is that the companies are forging deals with Trump that play into both bringing more manufacturing back to the U.S., which J&J has already announced plans to do, but also with regards to launching drug prices, lower drug prices, or launching them at the same prices as some overseas markets. So it'll be interesting to see what J&J puts on the table with Trump. We'll know that, I guess, when their announcement comes out, but I'd be surprised if they don't have an announcement soon because it is kind of the season for making these kinds of deals to avoid these tariffs.
Yeah, absolutely. Cynthia, great to get your coverage. Thanks so much for joining us here on the desk. Cynthia Coons runs our healthcare coverage for Bloomberg News. We're going to have more on Johnson & Johnson's earnings with the company's CFO. I may have mentioned he's going to join us at 10:30. Joe Wolk in the next hour. Also, coming up in the next hour, Tudor Jones joins me on the set to talk about concerns that we're in an AI bubble as well as the debasement trade. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment. Coming up, China raises the stakes in its trade fight with the U.S., this time targeting American shipping. We'll talk about that. Plus, Wall Street crushes estimates, a resurgence in deal-making, boosting revenue at JPMorgan and Goldman Sachs. And Fed Chair Powell gives us his read on the economy today in Philadelphia amid a lack of hard data. We're going to talk about that as well. The inflation numbers that would have been coming out tomorrow won't come out now until October 24th, and we're not even collecting at the BLS inflation data for October. So kind of flying blind here. The markets, you can see, down again, a little bit of a gyration after a 2.7% drop on the S&P Friday. We had a 1.5% recovery yesterday, but we're down 1% again today. NASDAQ down more, about 1.5%, as NVIDIA falls more than 4%. Bank of America did a survey of global portfolio managers, and 54% of the respondents said we are in an AI bubble. By the way, bond market back open again. The U.S. 10-year really unchanged, though, at 4%. That's your yield. Now, we welcome our TV and radio audiences for a conversation with one of the most respected traders on Wall Street. Paul Tudor Jones is known for his foresight. He shot to fame after anticipating the Black Monday crash in 1987. He then went on to make a series of successful global macro trades, like shorting tech stocks ahead of the dot-com bubble, but also big in philanthropy. He founded the Robin Hood Foundation, a charitable organization committed to fighting poverty in New York City. Every year, the foundation enlists the boldest names in finance in a stock-picking contest known as Pick a Ticker. And Paul Tudor Jones, I'm happy to say, joins us now here at the desk. Paul, thanks so much for your time. I want to first ask you about Robin Hood before we get to the markets, because I know you have a big conference with JP Morgan tomorrow, right?
We do. We have a conference tomorrow. There's still a few tickets that are available. We have some great speakers. I'll be interviewing Dario Amodei, who's the CEO of Anthropic. So actually, he's the person that should be answering your AI questions, not me. I can't wait. There's so many I want to ask him on AI. We've also got Ken Griffin and Jamie Dimon. It's going to be a fantastic and a very informative and educational day.
Will all of those guys participate in Pick a Ticker? Because this is a contest you do with Bloomberg, right?
Right. So Pick a Ticker is you pick one long, one short. It's a 6-month contest. Think of fantasy football meets the markets, because this year we're going to allow you to change your picks, I think 2 or 3 times during the 6-month process. So you put in $10,000. It's going to go to charity. 75% is going to go to Robin Hood to help the least among us in New York City, which sadly has twice the national poverty rate. And I think we've all got a vested interest in making sure New York not just survives, but thrives, because obviously Wall Street, which is the reason for so much financial wealth that all your viewers have, is something that we need to be able to, in New York City, have a thriving city, because the most important city in this country has got to always succeed.
Yeah, I mean, you have raised, I think, $3 billion over the time since you founded Robin Hood for fighting poverty in New York. I want to ask about Wall Street, and specifically about this equity market. Mm-hmm. I do watch our competition, and I saw your interview with Andrew last week. You said this is like October of 1999. Mm-hmm. But after that, as you pointed out, the stock market doubled. We had a drop in October, like an 11% intraday drop, but then the stock market doubled to March of 2000. Are we still in line for a doubling of this market?
Well, it's so funny, because you'd mentioned that 54% of fund managers think that we're in an AI bubble. If it's a bubble, it's a small one. If you just think about, and again, how do you actually define bubbles? If you think about the bubbles of the past 3 or 4 decades, the Nikkei in 89, NASDAQ in 99, biotech 2000, just after 2011, 12, China 2007, all those were 400 to 600% gains. The NASDAQ's up 200% off the bottom. So I don't know whether we're going to blow off like we did in 1999. Is it possible? Are all the ingredients in place? I think clearly they are. For me, the one thing that you can never, ever forget is that a year from today, assuming that the president gets his wishes, that the Fed funds rate's going to probably be in the 2.5. I think they would like to see it at 2.25. So I think 2.5, 275. Obviously, whoever the new Fed chair is going to have to be able to intellectually move that board, a majority of the board. He's probably, whoever the new Fed chair, let's say they've got 6 solid votes, so he'll have to find one more. And I don't think it'll be that hard to do. But if you're going to have 2.5% overnight rates or 275, that's a really compelling story for higher equity prices.
Well, not just that. I mean, you've got Neil Kasar on our opinion team yesterday laid out the argument that this is not the same as 1999 because these companies are so profitable, right? 95% of the S&P 500 is expected to post earnings growth next year, and the average earnings growth is 16%. It's obviously a lot more for the Mag 7 or the Great 8. Plus, you don't have the same kind of leverage that you had back then. You have less than 100% debt to equity, and in 1999, it was more than double that.
Right. Well, the only thing I'd say is I don't think you've got the leverage necessarily in the corporate balance sheets yet. You clearly have leverage within the equity ecosystem. And by that, I mean you just had a proliferation and explosion in derivative products. I want to say that levered ETFs are up 250% since the 2022 bottom. And I want to say that there's 400 or 500 with another couple of hundred in the pipeline. So you're clearly creating derivative leverage, whether it's in the options market, we see single stock options, we just see options activity exploding. Everywhere you look, there's greater leverage, again, in the equity infrastructure for what has become really trader nation. We have the highest percentage equity holdings by individuals in history. We have, again, more levered activity. You don't see it in margin debt because margin debt is actually an old anachronistic tool. You see it more so in the options markets. You see it more so in the levered ETFs. So it's somewhere down the road, a little similar. I don't think we're there yet, but somewhere down the road, there's going to be some real issues with that.
Nonetheless, you're long now, right? I mean, at least last time we spoke to you in June, you said your portfolio would be long stocks. You said you'd be long gold. You said you'd be long Bitcoin. And those have been great picks. Check out this chart, right? Gold alone is a 22% gain, but all of them are well above zero. Do you hold on to that portfolio?
So I would take them one by one. I think for stocks, the critical time is going to be the last week here in October, and when we see the big tech earnings, as well as by that point in time, we'll have greater clarity on the resolution of the U.S.-China conflict. I would think that if the NASDAQ is higher going into early November, then you've got a chance for a real ramp in the last 2 months. What happens between now and then, I kind of think the market's going to be on the defensive until we get to, that's going to be an intersection of just so many really, really important data points. So that's going to be a critical time. They also have a Fed meeting that week. So I would think, my prior is that it will resolve to the upside. We'll focus on where Fed funds will be. The market will look ahead 6 to 9 months and focus on that. Bitcoin and gold are interesting. They're interesting as a pair in the sense that if I just look at since Liberation Day, you've had about $40 billion of inflows into a combination of Bitcoin and Ethereum ETFs, and you've had a like amount of inflows into the combination of gold and silver. But if you think about it, the vol-adjusted $40 billion that goes into Bitcoin, because it's had, say, 5-6 times the vol of gold, was really a much, much bigger bet on crypto than it was on precious metals. And yet, gold has outperformed Bitcoin since that period in time. So clearly, retail has made a mistake in terms of trying to figure out which of the two debasement trades were going to outperform. And I have to admit, until a couple of weeks ago, I thought Bitcoin digital gold was going to outperform, again, the historic stores of value. I think they're both probably still good, but my guess is, again, we're here in the fourth quarter, momentum into the end of the year, that of those two, it appears that gold and silver are going to outperform crypto. You know, I'm always going to be a trend trader. I'm always going to follow the momentum. And I'm not going to be so prideful that I'm going to try to outguess what the market's telling me.
But you do think that we continue to see inflation? Because I've been talking to Neil Dutta from Renaissance Macro. He's pushing back on this. He says inflation hawks need to seek help. But his main point, I think, is that housing, the shelter component is going to come down. He said in a note last week, housing prices are likely declining. The fact that home buyer demand has declined even as rates have dropped suggests that a deflationary psychology has infected the housing market. You buy that?
I think I'm probably looking past current conditions, and I'm just thinking about the future. And we're in a fiscally constrained time. So why is it that the president is hell-bent on finding a Fed chair that's going to have easy money? Because the only way that we can reduce our debt to GDP, that you could even begin to deal with a 6% budget deficit, is to have the lowest funds rate you can possibly have to lower your interest costs, to stimulate growth, et cetera. The only way to reduce debt to GDP is to have, obviously, nominal growth exceed your interest rate. So in a situation like that, particularly given where we are in this economic cycle, where we are now, it's just hard not to see, and I think this is what the market's looking ahead to see, inflation not be rekindled and start up again, 6, 12, and in a more serious fashion, 18 months hence. You can kind of see it now. It's again, think of this. We have $370 trillion worth of global financial assets, 370 trillion. So when you come to a market like gold, which is 12 trillion, silver, which is, oh my Lord, a fraction of that, Bitcoin, crypto, which is say 2 to 3 trillion, it doesn't take very much. Then you start thinking about the copper markets and some of the other rare earth minerals, and you think about just individual commodities. Good gosh, the ability to elevate those prices because we have so much, again, money and financial assets. It just takes a small tweak to really begin to create a rise in the price level. And I think we'll see that, assuming that we have a new Fed chair who's going to take the funds rate down to 2.5%. And I think the White House is thinking they'd like to see the funds rate at 2.25 to 2.5.
Will we see a significant drop in the dollar from that? Because we had seen, right, in the first half, the biggest drop for the dollar since 1973. That's the year I was born, so a long time ago. But
you're a baby.
But we have, thank you. But we have recently seen the dollar recovering, showing a little bit of strength here as people look for, I think, safe haven in that.
Well, look, you've got an FX, you've got a fiat money debasement going on pretty much virtually around the world, right? The bond vigilantes, though, are being held in check by, again, central banks and populism that are pushing central bankers to run hot. So the currency debasement trade has really turned into a gold trade and a crypto trade, right? Bond vigilantes have been shunted to the back, told or been put in abeyance, and instead it's manifesting itself in gold and crypto. That's really what's going on. So again, look at the new Prime Minister of Japan. She's already advocating for the BOJ to go slow on normalizing rates. You can't make it up. They've got negative 1.5%, and it's almost like They just want to deny that they have an inflation problem. But so that's what we're seeing. And again, at some point in time, we're going to have some precipitous moments in sovereign debt markets. I don't know whether it's Japanese bond market, the U.S. bond market, but we're going to have some precipitous times. And if you just think about, we're not even close to that yet. We're not even close to that trust moment we had 3 years ago where the currency was under attack, the stock market, and the bond market was under attack. Just imagine if and when we get to that day, which I think with 6% budget deficits in the U.S., that day will come. Just imagine what gold and crypto, for that matter, the dollar, imagine what they're all doing. We're in good times now, right?
Even with the shutdown.
Yeah, even with the shutdown, we're in good times now.
I wonder what you think about you mentioned rare earths, and even we can't inflate our way out of that problem, right? J.D. Vance said, we have the cards, but it seems to me China has us between a rock and a hard place. Meredith Whitney put out a note on Sunday, and she says, don't bother being distracted by 100% additional tariffs that President Trump was talking about, because aside from the massive dependence on the U.S. industrial complex for these rare earth minerals and magnets, the U.S. military is 100% dependent on them and is nearly depleted of its reserves. Yeah. What can we do about that?
Yeah, I'm sorry, I don't have a good answer for that one. I wish I did. I really don't envy Trump and his cabinet trying to figure out what's going to happen here in 2 weeks. I really don't.
I just think of the strategy that it looks like the White House is following, right? They take a stake in MP Materials. They take a stake in Lithium Americas. They're trying to ramp up mining so they can produce these things. And at the same time, they're taking stakes in private companies. How do you feel about that as a long-term free market capitalist, the U.S. government getting in and picking winners and losers?
I'm not in favor of that. And again, the reason why is it's the same reason. My concerns are I see concentration risk everywhere I look. Well, now we have individual investors with the highest equity allocation they've ever had in the history of the United States. Really 4 times that of the rest of the developed world. So I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, again, if you just think about the number one rule of portfolio management is you want diversification. That's why our founding fathers created us as a democracy, not a monarchy, because you want that contestation of ideas. So I'm nervous when I see concentration virtually in anything. Again, whether it's in the stock market, whether it's the composition of the stock market, who owns the stock market, or the decision making that's getting made in Washington. It makes me nervous because I don't think in the long run, right? Even if all the decisions that President Trump is making are great, is that going to embolden the next president, who may not make as good of decisions, to do the same thing? So I'll look at that, and again, it raises caution flags for me.
But you're still long stocks right now? You're still long the NASDAQ?
I am. I wouldn't say I'm long at this second. I'm clearly. Again, I think there's such a confluence of possibly negative, possibly positive events. I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
All right, so just to end on where we started with the pick a ticker contest for Robinhood, I asked you last time, and I'll ask you again. For players at home, what tips would you give us? What would you put?
I'll probably, I think it's going to begin November 1. I'm sure I'll probably be long. The NASDAQ will be my long. Remember, you see, it's really interesting because the last 12 months of a bull market, typically you double the annual gains up until that point in time. But that's to the end of the bull market. So we've got this situation confronting us where the best part of the market's possibly straight ahead, but it's also the most dangerous because it could be the top. So I would probably long the NASDAQ would be my long, and I've got to think about what my short would be. It could be, it might be the bond market again, though that'll be a bit boring.
That wouldn't be boring. I'll take it.
Okay.
Paul, thanks so much for joining us. Really appreciate your time. Paul Tudor Jones, co-chairman, chief investment officer, of course, of Tudor Investment Corporation and the founder of Robinhood. Still ahead, earnings season kicking off on Wall Street. We'll take a look at results from the big banks again next. This is Bloomberg Open Interest.
It's important to note that particularly for JPMorgan and the other investment banks, this was probably the highest bar that we can think of in many, many years with respect to just the expectations going into these numbers. And it is no secret that deal activity is very high, and there's been a lot of optimism around IPO, secondary activity, as well as M&A. Trading has been very good.
That was David George of Baird speaking with me earlier after JP Morgan reported strong results, beating estimates for trading and investment banking fees. Bloomberg's chief Wall Street correspondent, I should say, not Washington, right here in New York City. Sridhar Natarajan joins us here at the desk. So I feel like, why do I have to say they beat? I mean, they always beat, right?
Fine, so let's not look at estimates and actual and what the results were, but let's look at what the market's doing, because since the market's open, you have Goldman Sachs down 3.5%, JP Morgan down 2.5%, Morgan Stanley down 0.5%. So clearly, even though the numbers were really good, and really that's what we saw across the board when we look at the earnings that were published today, Goldman Sachs, JP Morgan, Citigroup, all of them performed better than estimates. You're cynical about estimates, understandable, but it is a reflection of the improving market environment for these banks, especially on the investment bank side. On the trading desks, on the deal-making side, there has been visible improvement. There has been an uptick in activity, and that is playing through in fees. That is playing through in trading unit revenues. But then the question obviously is, why is it the case that the stocks are performing the way they are? Usually on bank earnings days, you'd perhaps say bank stocks are what's wagging the markets. Today, it seems the other way around. The markets are wagging the bank stocks. Because the overall broader sentiment, what's happening with China, that growing spat on the trade relation between US and China, that is obviously having a big impact on the broader markets. And for these stocks that have had such a good run so far this year, it's perhaps time for investors to take a bit of a pause and make sure that they're not in for some sort of root shock and there's no sudden reversal, and that's why you're seeing some risk being taken off the table.
Yeah, I mean, as David George says, about JP Morgan specifically, he said, great company, expensive stock. So you can differentiate those two things. Sri, thanks very much. Sri Natarajan there covers banks for us on the other side. You can follow all the coverage from Sri and Cato and the team on the T-Live blog. If you have Bloomberg in front of you, type TLIV. Go. Coming up, one company moving closer to its 24/7 trading target for U.S. equities. Dmitri Galinov from 24 Exchange joins us next. One company moving closer to 24/7 trading is 24 Exchange, launching its 24X national exchange today. It allows registered brokers to trade U.S. equities from 4 a.m. to 7 p.m. as demand grows for around-the-clock access to U.S. stocks. Joining us now is 24 Exchange founder and CEO Dmitri Galinov. Dmitri, it's something that, we've been pushing for so long. Why has it taken until now to get this out the door?
It's a huge change for U.S. market microstructure to go 24 hours. Imagine how many firms have to change. We have DTCC, we have SIP, we have many other exchanges. So it is taking some time, but certainly today is the first step to see that change.
Apparently we have a microphone problem. Maybe we can get a stick mic out here. Or there you go. All right. See, that's easily solved. All right. So what are you starting with? Are we talking about equities all around, or is this just going to be a limited opening?
Well, we are going to roll out to the full 7,000 regular mass stocks by next week. Today we opened some stocks. So today our first trade was in Google, 66 shares. 42 seconds into our opening, we had over a dozen participants participated, so very excited.
And what's demand look like at 4 a.m., at 6:30 p.m.? How strong do you expect that to be?
I think it's going to be very strong once we open up the exchange to go overnight. I have been to Asia many times, especially in Korea and Japan. The traders, they have Tesla dealership, McDonald's dealership. They watching NVIDIA earnings, and they want to participate in real time. They don't want to wait till the next day.
So how do you drive volume, though, outside of just waiting? You build it and they come, right? That seems to be the tagline of the day in AI. You obviously have to do a little bit more work than that. How do you drive volumes?
Sure. Well, first of all, we have built, and they did come. We on the day one, we have 28 large broker-dealer participants. We're talking about big global banks. So when you have 28 big global banks on day one, you do have pretty significant liquidity. In addition to that, we have to compete with our exchanges like New York Stock Exchange and NASDAQ. And we compete on cost basis. So we are New York Exchange. We are more efficient. So we have much better pricing, as well as we operate much more in technology. So we can make changes faster.
I wonder about overnight trading. I was just joking with you a little bit during the commercial break about I want Columbus Day off, right? As somebody who has to work when markets are open, maybe I'd like to see less. But I'm sure that banks feel differently. But are they going to have employees overnight to do the trading?
Absolutely, because banks, they have demand from their Asian clients. So the Asian clients, they demand to trade when they up. They don't want to trade, 3 o'clock there in the morning. So certainly banks have to support that because, the clients calling them and say, look, we want to trade, and banks will earn significant profit on that. I think that the 24-hour trading will significantly contribute to bank profitability over time. It's just because of more Asian flow come here.
I was watching, obviously, big bank earnings out today, and Blackrock as well. Larry Fink was saying he thinks tokenization of all assets is just beginning. What do you think about tokenization?
I like tokenization of assets, especially private companies and real estate. I think it gives it more liquidity and more access. I don't think we're going to go far with the stock tokenization because U.S. markets are most liquid and efficient markets in the world, and they're protected by the Securities and Exchange Commission rules. So I doubt that tokenization will change that, but certainly other classes, asset classes that not as efficient as U.S. stocks are a good target for tokenization.
The reason I ask is because I hear about tokenization a lot of times from companies that I imagine, if they're not your competitors, they will be soon, right? It's an incredibly competitive space. How quickly do you expect everybody to catch up to the trading hours that you're operating in?
Well, so far we are the first and the only stock exchange that have received 23-hour trading permit from the SEC. Yeah. We do have NYSE that have received a 22-hour trading permit. NASDAQ and CBOE have said that they will change their hours, but they have not received the permit yet. But certainly, I think by the time the 24-hour trading will be in full effect, we'll have 3 or 4 exchanges, which is great because you'll have more liquidity overnight when you really need it.
Dmitri, you mentioned the demand overnight obviously isn't from Asian traders, and they love to trade stocks. Is there a point at which you see overnight volumes matching what we have during the day in U.S. markets?
Absolutely. It depends on stock-by-stock basis. And for example, there are some stocks that are listed here, and maybe because of 24-hour trading here, it's a very big market, we're going to have more stocks, attracting more international stocks. But if it's an international stock, the most volume they do when we sleep. So it's completely possible where a stock actually going to do more overnight. It depends when it's located, what its revenue is, what it's interested. But it certainly, I can see that happening.
All right. thanks so much for joining us. You rolled well with the changes on the microphone. Dmitri Galinov there of the 24 Exchange. Just get a quick check on what's going on in the U.S. markets right now. It's 10:35, so just over an hour into the session. We're looking at losses, but they're not nearly as steep as they have been throughout the morning. Right now, the S&P down just 0.5% or 36 points to 66.18. The NASDAQ down less than 1%. Let's look at some of the single stocks moving at this hour. AMD, NVIDIA's nearest rival in AI processors, says Oracle plans to use 50,000 of its chips, 50,000 AMD chips next year for its data center build-outs. So that helps AMD shares advancing 2.1% in a down market. Also, Goldman Sachs, we talked about the numbers in terms of earnings. It's announcing further job cuts this year in a memo. The stock was down, as Sri and Cato were telling us, on the macro concerns that are pulling down the rest of the market. Also, maybe a little bit of buy the rumor, sell the news trade. But Goldman says there will be a limited reduction in roles. And Blackrock reporting quarterly results. Just told you what Larry Fink said about tokenization. He's also talking about pulling in $205 billion in client money as the bank expands its footprint in private credit and alternative assets. I believe Blackrock is now looking at AUM in total of well over $13 trillion. Joining us for more on BlackRock's earnings is Neil Sipes, Bloomberg Intelligence Financials equity research analyst. Neil, this is a behemoth. What are we looking at? Like total assets under management for BlackRock now?
Yeah, so you're right. It's 13.5 trillion now, and I think the story here for BlackRock is we're starting.
By the way, that's bigger than the entire gold market. Paul Tudor Jones was just telling us the whole gold market is a $12 trillion market.
Yeah, and I think when we look at BlackRock, we're starting to understand that it's defying the law of large numbers. For a long time, it's been the question of when they were approaching 10 trillion, are they still going to be able to put up that kind of growth that we've seen across the ETF franchise as that product has penetrated markets long term? Now those growth stories are sort of shifting in a more fee-accretive way towards those private markets categories, while that ETF franchise continues to sort of propel BlackRock bigger and bigger. Of course, we know markets have been at the back of BlackRock for the past handful of quarters. I think we're seeing about $1 trillion increase in AUM on a quarterly basis. But in the most recent quarter, we saw 200 billion in inflows, 170 billion long term. That's 6% organic growth. In the world of traditional asset management, you don't typically see a lot of competitors putting up those numbers because of the stories in active mutual funds. So
I want to just ask about the tokenization issue. I'm sure you saw his interview on CNBC earlier. That sounds kind of out there to say the tokenization of all assets is just beginning. Does he think everything is going to be tokenized digitally?
It sounds like it, and I think that's sort of where we are now is sort of understanding what feasibly can and what should be tokenized. They've talked about ETFs being tokenized. This is going to be a much longer opportunity in sort of tapping the assets that are in wallets that are demanding tokenized products.
It's a tailwind for the whole industry, isn't it?
Yeah, and I think from this perspective, it's more of an incremental opportunity long term. But nonetheless, BlackRock is likely to be one of the players leaning on that $13+ trillion asset base and pretty much penetrated across all clients, institutional and retail, being able to provide the product that clients are looking for, being vehicle agnostic, as most asset managers talk about whether or not that's positive for fees, is sort of the way things are going.
But I guess the headline from the quarter is that private assets are really helping BlackRock to grow. And that's the story for the industry as well, right? As public markets seem to hit a ceiling in terms of, or even shrink in terms of the assets available, investors are reaching for those private assets.
Yeah, absolutely. And there's really two products that are growing close to or at double digits, on an annual basis, and that's ETFs, and then that's private markets on the other side. And of course, we saw BlackRock acquire HPS and GIP and Preqin last year. So those are starting to come in, and I think the numbers that we really honed on to sort of contextualize the private markets opportunity is those two transactions, HPS and GIP, that added about 2% of BlackRock's now 13+ trillion, but it added revenue of over 10% to BlackRock, right? So you think about adding those high fee product categories that are growing much faster alongside the, of course, legacy iShares product.
All right, Neil, great having you on the program. Thanks so much for joining us. Neil Sipes there of Bloomberg Intelligence. You can find his work by typing BIGO. If you're in an individual equity, by the way, on your terminal, type BICO GO to find the analyst who covers that company. Coming up, pharma giant Johnson & Johnson boosts its full-year forecast, and we're going to talk to the CFO. J&J's Joe Wolk joins us next. This is Bloomberg Open Interest. Johnson & Johnson shares drop amid a broader sell-off in the market. The pharma giant, though, boosted its sales forecast for the full year. Also, it announced plans to separate its orthopedics business from the rest of the company within the next 2 years. Joe Wolk, the CFO of J&J, joins us now to talk about both of those things. Joe, great to have you on the program. Thanks so much for joining us. Let me ask first about the orthopedics business. I would have thought, because of the demographics in this country, in this world, that the orthopedics business would have some pretty sweet growth. Why are you spinning it off?
Yeah, good morning, Matt. It's a pleasure to be here, and thank you for your interest in Johnson & Johnson. Yeah, the orthopedics business is a very strong business. It's a slower growth, lower margin business than what is in the rest of our portfolio. And as you know, Matt, having covered Johnson & Johnson, over the past few years, we've made a conscious effort to move to the higher growth markets, the higher margin products, with the acquisitions of Abiomed and Shockwave. If you think at what Johnson & Johnson has been successful at for decades now, it's really being rigorous managers of the portfolio. And so we go to those areas and we thrive in those areas where there's significant unmet need. While demographics are helping the orthopedics business, and it plays in a large $50 billion market for the industry, the higher growth levels, that unmet need, isn't there as prevalent as it is in other parts of our business, specifically in medtech and cardiovascular surgery and eye health. Again, this is a profitable business, has strong cash flow, but it's a business that often goes up against singularly focused orthopedic companies. So we think this will actually make them more competitive. It's the most comprehensive orthopedics portfolio day one after separation.
In terms of when you're going to get it done, how shareholders are going to experience this spinoff, what should we expect?
Yeah, so it's going to take 18 to 24 months based on our projections. We are going down the path of a spinoff. It's the most resource intensive for us internally. It's also probably the most time consuming or the longest duration to do a separation. But we're going to explore every avenue that comes our way with respect to increasing shareholder value and really setting up the DePuy Synthes business for future success.
All right, let's talk about then the earnings now. You beat expectations and you raised your guidance. What were the biggest drivers to that?
Yeah, you know, Matt, it was evenly distributed across the board. So if you look at the top line beat, it really was attributable to kind of how our lines of business break out. Roughly 2/3 of the beat was innovative medicines, strong product performance in Tremfya, which is a product for psoriasis as well as inflammatory bowel disease, Spravato for severe depression, new products coming to market like Inlexo for bladder cancer, and Rybrevant plus Lazcluze for lung cancer. On the medtech side, equal beat there. We did better in cardiovascular across most of our areas. Eye health continues to perform. Interocular lenses have once again hit a double-digit quarter in growth after the introduction of new products late last year and into this year. And then surgery continues to do well, and we're looking forward to having our own digital robotic platform sometime next year for product launch. So we're kind of making the announcement on orthopedics today really from a position of strength. And while this quarter was great, it's become less of a data point and more of a trend. And it sets us up not to just close out 2025, but really gives us a strong backdrop for 26 and the balance of the decade, given some products that are coming through in the pipeline.
Joe, as we look forward, I know that the picture will change depending on what you announce following your talks with the administration. How are those negotiations going after we saw announcements from Pfizer, from AstraZeneca?
Yeah, it's a great question, Matt. Obviously very timely. I could say that Joaquin Duato, our CEO, as well as our government affairs teams, have been highly engaged with the administration, even prior to the inauguration, I would say since election. They want to hear from the most comprehensive healthcare provider, quite frankly, in the globe. And they've been very open to what we had to suggest around tax policy, we're all looking for the same type of common ground, I would say, and I think there's common ground to be had in providing incentive-based innovation for healthcare, as well as providing access and affordability to patients for these great innovations that are coming about.
What effects do you expect the deals negotiated so far with your competitors to have on the industry? What does drug pricing look like in 26, 27?
Yeah, it's hard to say because really, from what I can tell, and there's very scant details at this point from the two agreements that have been reached, but it seems like it impacts the Medicaid population. And each manufacturer, quite frankly, has different drugs for different populations with it that impact Medicaid. So it's kind of hard to generalize, if you will, for the industry. But I think we'll be very well positioned here at Johnson & Johnson, just given the cadence of innovation of new product launches that we have. Remember, Matt, we came into this year with a product known as Stelara that treats psoriasis and inflammatory bowel disease that was facing loss of exclusivity. That product last year for Johnson & Johnson approached $11 billion. In fact, our portfolio, if you take out Stelara this quarter in pharmaceuticals, grew about 16%. And we think about these things, years in advance. We plant seeds so that big oaks can grow. And so you look at some of the newer product launches that we expect to have next year. Icotrokinra is another product for psoriasis and inflammatory bowel disease, biological efficacy in the form of a pill. We acquired that for hundreds of millions of dollars in 2017. That will likely be a multi-billion-dollar platform for us going forward. So we're very pleased with just the position of our pipeline, the new products that are coming, and it's really about the strategic intent of going after unmet medical need and elevating the current standards of care.
Nothing to fight food noise, Joe?
The food noise?
Nothing, no GLP-1 similars on the horizon?
No. We'll, it seems like there's some really good companies that are advocating that, but it really speaks to what I think the healthcare industry does for society. We think about it in terms of our investment of $55 billion here in the U.S. The Trump administration is very focused on providing jobs. The industry has more than 5 million jobs related to life sciences, and we think that is healthy for society, but also healthy for economic growth here in the U.S.
All right, Joe, thanks so much for joining us. Joe Wolk there, Chief Financial Officer at Johnson & Johnson. Coming up, the IMF says sweeping U.S. tariffs are putting strain on the global economy. More on that next. This is Bloomberg Open Interest.
I see concentration risk everywhere I look. Individual investors with the highest equity allocation they've ever had in the history of the United States. I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, the number one rule of portfolio management is you want diversification.
And that was legendary investor and philanthropist Paul Tudor Jones sharing his views earlier this hour as stocks fall on rising trade tensions. The IMF issued a warning this morning saying sweeping U.S. tariffs are putting strain on the global economy. Joining us now is Bloomberg International Economics and Policy Correspondent Mike McKee. He is in Philadelphia, where Fed Chair Jay Powell is set to moderate a panel. And Mike, Paul Tudor Jones said he thinks the terminal rate could go down to 2.75%, 2.5%, even 2.25% with the right Fed chair in place.
Well, the hard part, Matt, is knowing where the economy is and what the growth situation is going to be. You take a look at what the IMF put out today. They said the outlook is dim, and they blamed U.S. tariffs and trade tensions. But they also raised their growth forecasts for just about every country in the world, including the world. You can see from their July forecast how everything has gone up. Now, 2% growth for the United States is not huge. And certainly for the Eurozone, China, and UK, those are low numbers. But there's still growth. And they are seeing a little bit more strength because the tariffs seem to be hitting a little bit less. So it's going to be hard for central bankers to know exactly what to do.
In terms of inflation, what is the expectation right now? Because we're kind of flying blind. We will get CPI on October 24th, but it's been trending back up over 3%.
Yes, expectation is that the CPI will still show the core over 3% and the headline very close to that, some additional inflation. Right now, we're starting to worry about whether we will even have an October CPI report because of the government shutdown. Jay Powell, it would be interesting to see what he says about it, because when he spoke shortly after the last Fed meeting, he said there's danger on both sides and there's no safe path. But does that mean that the Fed starts to cut rates, or do they get more cautious going forward? Everybody's going to be watching his speech for that, because, of course, the blackout starts Saturday.
And we will bring you that speech right here on Bloomberg Television. Mike, thanks very much. Bloomberg's Michael McKee. This is Open Interest.